For more on the tech stocks, let's now bring in Ross Gerber. He's the CEO of Gerber, Kawasaki Wealth and Investment Management. Ross, good to be able to catch up with you today. Let's just get right to it and talk about your expectations for Google as well as Amazon as we await these numbers. I'll break them when they come out.
Well, I think it's kind of like almost like a tale of two different cities here. With Google, I'm really kind of concerned because they obviously have a great search business and YouTube is obviously very monetizable. But it just seems like they don't really, like all these other bets really haven't paid off for them. And we're not seeing any real like driver of future growth, like other than their core businesses while they sit on a ton of cash. So, I'm interested to see if they give us some guidance to like, where's Google really going for growth over the next decade? And Waymo, I'd like to hear an update of how Waymo's doing because, I do think they're kind of behind with that. So that's how I feel about Google. Where with Amazon, I'm super bullish, and I love what they're doing, and they're pivoting into many different markets that I like, and the innovation there just never ceases to stop.
Ross, let me just interrupt you for one moment because we do have the results from Alphabet, and that, of course, being Google's parent company, and Amazon coming out as well. Let's just do Alphabet first. And let's see, a lot of different numbers here. We've got the revenue for the second quarter, $38.9 billion. Net is $9.95 billion. And the earnings, $14.21. We will get some of the comparisons in just one second. And let's just take a quick look here at Amazon as well. In terms of the most recent results, and we'll also get the stock reaction as well. As it relates to Amazon, it looks like a beat on the top line. Net sales for the second quarter, $63.4 billion versus $62.5 billion. And the earnings are $5.22. Net income, $2.6 billion. Operating margin, $4.9 billion. So a couple different data points there. And stock for Amazon is, in fact, trading down. The second quarter earnings was they came in at $5.22. The consensus was $5.57. So it does look like a miss on the second quarter bottom line numbers. And, of course, that was one of the potential concerns, Ross, was that the spending might actually be more than people were expecting. We're going to dig into that in a second. But your quick reaction here? Yeah,
exactly that. I mean, Amazon, like other companies, sort of reminds me of Tesla, too, what Tesla's trying to do. They're not scared to invest for the long term. This quarterly focus is so detrimental to long-term business planning, and Amazon's never been concerned about that. And I think over time they've proven that whatever they're investing in has been worth it. So that's how we feel about Amazon. And if they're spending more money now, it's going to pay off for them later. And we know they're investing a lot in making shipping even faster and more efficient. So it's really putting a lot of pressure on its competition.
It is, but at the same time, too, we also saw AWS coming in a little bit light versus expectations, and that, of course, is one area. We're still talking about Amazon, but Google stock obviously up. This is opposite versus what the street was expecting. They were actually perhaps expecting that Google was going to be maybe disappointing, as you just said, Ross, and Amazon beat. That is not the case in the after-hours market as it relates to how these stocks are performing. But let's just get back to Amazon for 1 second here, because AWS, their net sales came in at $8.38 billion. Expectations were for $8.51. Bit of a miss there. And this is the area of growth. This is the area of higher margins. This is what investors need to see happen. And they missed.
Well, this is exactly, we're also big investors in Microsoft. And this is exactly what the competition in the cloud is starting to do. Now you've got Google, Microsoft, and Amazon, vying for the same clients. And that's going to affect them going forward. But I think when you look at just on a pure growth basis, these businesses are doing very, very well. It's what the expectations are set by Wall Street. Maybe they miss by a few pennies here and there, and these are growing businesses that are very profitable. It's hard to be concerned about either of these companies,
That's probably that's probably fair. Would you be buying on weakness as it relates to the Amazon shares today?
Oh, for sure. We're buyers of Amazon and Google. They're top holdings at my firm. I was just talking to some young people about this, about when you think out 5 years into the future, what companies are going to be dominant 5 years into the future? And I don't think anybody has any doubt that Google and Amazon are going to still be in the positions they are in today, or maybe even better positions in 5 years. So I think these are kind of core holdings that you need to own. And so if they pull back, we add to them.
Okay. Interestingly as well, let's take a look at the shares of Intel, if we can, in the after-hours market. They also reported, and they have a beat on the bottom line. Their adjusted earnings came in at $1.06 versus 89 cents. We got to take a look at that a little bit further. Their revenue was better than expected, $16.5 billion versus $15.67 billion. That's a nice beat, obviously lending itself to a beat on the bottom line as well. We'll see how the stock is currently trading. Importantly as well, Intel did raise their fiscal year view to an adjusted earnings of $4.40. So they were raising their fiscal year view. That should be received quite well in the marketplace. We'll see that in just a second here. And also, their second quarter 2019, they're announcing a 5G smartphone modem divestiture. We'll have to see how that plays in to investor sentiment as well. What are your thoughts here? Stock's up by close to 7%.
You know, it's great. You know, the semiconductors have come in pretty strong this earnings season, and there's been a lot of pressure on these stocks across the board. Intel obviously being the monster in the area there. So it's good to see these good numbers because they have such a big, broad international technology business that it shows that there's still underlying strength in, you know, core technologies, servers and PCs and such that, you know, they service. The thing about Intel we don't like is the fact that they've given up on 5G modem chips and they've ceded that to Qualcomm. And we think this is a great business to be in over the next 5 years. So it looks like Apple wants to pick this up because they don't want to have to be completely reliant on Qualcomm. So I think it's the same thing. You know, what is Intel's next step if they're not going to be in 5G? But that being said, it's a great business, and they're obviously doing pretty well.
Okay. I also want to give our viewers another big bellwether that reported after the closing bells today, and that is Starbucks. Let's bring this stock up in the after hours as well. I don't know if you've seen it already, Ross, because you were speaking, and it just came out. But wow, these same-store sales numbers, 6% versus the estimate of 4.2%. That's a big number for any retailer, let alone a behemoth like Starbucks. Their earnings came in at 78 cents versus 73 cents, so that's a nice beat as well. And we'll look for some guidance here. But quick reaction?
Yeah, I mean, we're Starbucks owners, and I have been for a long time. And honestly, we've been accumulating the stock. It's been really under the radar, and it's been looking really nice lately. So I like the numbers. You know, the new CEO is doing a great job and focusing on technology and efficiencies, and that seems to be paying off. Starbucks is also a core holding at my firm, and we love the brand and the company, but it's great to see them executing with new management. What
do you think was the issue at Starbucks? Because you're right, it had been under the radar. People had been very concerned about it, about the momentum or lack of momentum. The bears on the stock would say, I'm concerned about China. I still need to get the China number here as well, which I'll get in one second. Global same-store sales up 6%, so that's a good number. Obviously, China's part of that. But why was it so under the radar, and why did you get into it?
Well, I've been in Starbucks for a long, long time. I love businesses that people don't quit, and nobody quits coffee. It's really, really hard to quit coffee. And Starbucks, you know, is obviously the key brand, and it's a lifestyle. It's not just drinking coffee. It's I go to Starbucks every day, and people do. And what really we liked about Starbucks that the story isn't being told is the efficiencies that they've driven through technology, like being able to order your drink online and go just pick it up. And now with delivery, I mean, boy, the sky's the limit. I mean, people are getting, you know, Starbucks any way they can. So that's obviously working. But I think also with big, large global logistics companies like Starbucks, this is where technology efficiency and also the power of social media and online advertising can be leveraged to create better margins and better results from legacy businesses. So Starbucks has continued to adopt while many other retailers and restaurants really haven't. And that's why I think they're seeing success.
And just to give another data point here, which I think is important, let's still bring up the Starbucks stock, is they are raising their fiscal year 2019 global comp store sales numbers. So that's a real positive. And they're also raising their bottom line earnings outlook to a range of $2.80 to $2.82. That's up from $2.75 to $2.79. So that's a nice raise. The other aspect, though, that we'll have to see how this gets interpreted by the street, probably a positive, but they are cutting their fiscal 2019 net new stores view to 2,000 from 2,100. I don't know if that's going to do much to the stock, but you know,
I think that's good. You know, there's a lot of Starbuckses, so I would prefer them to be very strategic about opening new stores so they don't cannibalize. And most of these stores are being opened in China. So this might just be them being a little bit more cautious about slowing down the expansion in China as the trade war continues to grind on. And also the Chinese economy has slowed dramatically. So these kind of expensive coffee purchases might be affected by the slowing Chinese economy. So that it's probably just prudent management.
Yeah. Okay. You always want to see that it's prudent management and not a lack of momentum in terms of their brand and the desire to go to their stores. That's why it's always a little bit, you got to dig into those details a bit when you see company managements close the planned net new stores. But your take is positive.
Yeah, because remember, with all these like chain type stores, you know, it's so easy to like put too many stores in a market just to say you have stores. But what we've really learned with retail moving over the last decade is it's not just how many stores you have, it's how effective those stores are at reaching your customers. And that's the thing about locations that become a little bit more tricky, you know, than just opening up a ton of Starbucks and people will come, which worked, you know, for a long time for them.